it going? It's Elena and welcome back to my channel. So happy you're here. I talk about a lot of things on my channel and occasionally talk about personal finance and financial education. And today I'm back with another video. I've talked a little bit about the beginning steps to learn how to invest your money, but with that can come a lot of uncertainty and fear. I promise the beginning steps to investing do not have to be too nerve-wracking or overwhelming. So I figured for those of you out who are kind of starting off on your financial journey, I would go over some top beginner investing mistakes to avoid. Starting off at number one, the first thing to avoid is not investing. And that sounds maybe a little self-explanatory, but let me tell you why. A lot of people out there think it's safer to essentially just keep your money sitting in the bank and will be sitting on cash for years, if not their lifetime. And the thing is, you actually are losing money when you are not investing it. When your money is just sitting in the bank, it's losing money because of inflation. Investing is great because it essentially helps your money grow and work for you. There are a few steps that are really important. It's very important to have an emergency savings fund. If you don't have any savings, I wouldn't recommend investing a bunch of money tomorrow. I have other videos about that. It doesn't necessarily have to be a ton of money. Experts recommend 3 to 6 months of income so that if something were to happen, let's say you fall ill, you lose your job, something drastic happens, you have that money set aside so you can pay for your rent, your electricity, your groceries, the important things to get you by. And it's also important to pay off high interest rate short-term debt before investing as well. I've heard this before that the best time to start investing was yesterday. Time is a really important part of investing because it gives your money the chance to ride the ups and down waves of the stock market, which can be a bit scary and precarious. It's easy to want to pull out your money when you see it's going down, but historically the stock market has an upwards trajectory, which means slowly over time your money is projected to grow and to increase. There's also the power of compounding with certain investments, like investing in a 401k, certain investments in a Roth IRA. The power of compounding helps your wealth and your finances grow exponentially. It takes the profits made and reinvests it back in that principal amount and then invests it all together so that entire sum then has this accelerated growth process. I really do think it's important to set some type of goals for yourself to stay on track. You don't have to have it all figured out. I sure as hell do not. But it is important to kind of know why you're investing. Everyone's goals are very different based on their current situation and what they hope their outcome to be. I think that's really important to keep in mind. It's really easy to compare yourself to people you see around you. But chances are they're starting off with a different place as you and they have different desired outcomes. So it's like, what are your own goals? Where do you want to be in 5 years, 10 years, 20 years? Are there certain things you want to save for? Like, do you want to invest in real estate down the line? If you don't know why you're investing, it's really easy to lose motivation, but I like to see money as a tool to set up my future self for success. The third mistake is trying to time the market. Nobody knows with certainty what the stock market is going to do. It would be ideally great if we could all just start investing when the market is at a really low point, but you never know what the next day could bring. The low point could get lower or it could immediately shoot back up. Many people try to time when to buy and sell, essentially make fast cash. That's kind of what day trading is. It's extremely risky. Even some of the most intelligent, well-researched, experienced people still often can mess this up. Time in the market generally beats trying to time the market. I'll reiterate this across a couple different points throughout this video, but like I said, it's more important to just start investing today. Time is what is really on your side when it comes to long-term investing, which is how I try to do all my investments, and I think is one of the best ways to passively invest is to put your money in something like an index fund, etc., which we'll dive into more a bit later, and to let it just sit and ride the stock market for a really long time. And the sooner you start, the younger you start, the better. The index fund pioneer John Bogle once said, "Sure, it'd be great to get out of stocks at the high and jump back at the low, but in the 55 years I've been in the business, I not only have never met anybody who knew how to do it, I've never met anybody who knew how to do it." So you just gotta be prepared to stick it out for the long run. Again, the best day to start was yesterday. As we're talking about avoiding mistakes and potential financial stress, let's take a second to talk about mental health and thank our sponsors for today, BetterHelp. BetterHelp. If you're unfamiliar with what BetterHelp is, I for one have been a long-term fan. It's essentially online counseling services. So it is a great way to take control of your mental health and really prioritize that and your needs. BetterHelp will assess and match you with a licensed therapist all within 48 hours. You can start chatting to somebody and kind of talk through whatever it is you want to talk through. It's not a crisis line, it's not self-help, it's professional therapy done online very securely. There's a really broad range of expertise. They have over 20,000 therapists online, so you can definitely find the perfect person for you. A lot of times therapy in person can be expensive, while BetterHelp is generally less expensive than more traditional in-person therapy. And it's really great because you can access them at any time via chat, or you can set up a call or a video call, which I really like. It's available worldwide, which I think is really great, and they have financial aid available as well. So, take control of your mental health today. It's BetterHelp, HELP.com. Join the other 2 million people taking charge of their mental health with experienced professionals. I have a link for you down below too to get 10% off your first month. If you want to try it out for yourself, I highly recommend. And thanks so much to BetterHelp for sponsoring today's video. Another mistake is investing too much money as you are starting off as your investing process. It's really important to kind of practice to see what works for you and what doesn't. Investing is definitely a learning experience. There's a lot to be uncovered as you go, so you don't want to rush into anything too quickly. Money that you invest, you really want to view with a long-term lens. It's not like it's something where you can just pull money in and out. A lot of investments are meant for the long run, 5-10 years, if not 20 or 30. And so you don't want to over-invest. At the end of the day, there are a lot of risks that come along with investing in the stock market. It can mean that you lose a portion of your investment. So you don't want to put in anything that you can't afford to lose that will leave you feeling high and dry. There's also this term of dollar cost averaging. Dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in effort to reduce the impact of volatility on the overall purchase. Let's just say you have $10,000 that you're ready to invest. If this is your first time investing and that's like the most that you have ever really saved up, it's not best to put that all into one stock in one day. Using something like dollar cost averaging means that you break that down into increments of, let's say, 1,000 or 500 or whatever the case is, and you slowly invest that over time. By doing that, you're kind of preparing for the volatility of the stock market. Dollar cost averaging essentially minimizes the impact of the roller coaster that the stock market can be. The next mistake is constantly watching the market. Just don't do this to yourself. I'm like, for your own sanity and mental health, just do not. It's not worth it. I'm gonna say this again and again, but a lot of this investing to prepare for the future is long term. If I looked at my investments daily, I would be having anxiety attacks left and right. I have technically lost a lot of money, but then over time, the stocks have gone back up and I've regained it. And it is terrifying to see or to overcheck your investments, especially when the stock market is in a decline. It feels like all your money is going away, but you gotta ride the old stock market out, and things usually even out over time. If you're constantly watching the market, it's really easy to get swept up in the excitement and the anxiety and the frustration surrounding it. It's of course important to know what's going on with your investments and to understand what's going on. Don't overdo it. Markets are constantly moving and changing, so checking too frequently can lead to some rash decision making. The next common investing mistake to avoid is not diversifying your portfolio of investments. Essentially, don't put all your eggs in one basket. If you have too much money banking on one stock, you have a lot less room for error. One way to diversify is to look at the different assets you want to invest in. There's a lot of different asset classes like stocks, bonds, index funds, ETFs, mutual funds, and it's generally wise to spread your investments across these different asset classes. For example, stocks are higher risk but have the potential for higher reward, and bonds are lower risk but also have smaller financial rewards. Different asset classes tend to perform differently and react differently in times of financial turmoil. This is a great time to talk about index funds as well. If you're unfamiliar with an index fund, it essentially is a fund that tracks a certain market index. For example, like the S&P 500. An index fund is like a big old basket that has a bunch of different eggs within it, and those eggs are generally a bunch of different stocks or different assets. Instead of just investing in one stock, you're spreading your money over many different stocks. So a little bit into a lot of different stocks Therefore, like we said earlier, it can kind of offset the gains and the losses, because instead of one egg, you got your whole basket going for you. Index funds are kind of seen as, for one, a really easy way to invest. You can do it on your own. You know, you don't have to work with a financial advisor, a manager, anything like that. And it's a long run game. You put your money in, you're a passive investor, and you just let it sit and work for itself over a long period of time. The next mistake to look out for is not taking the time to understand the market. In order to make the best financial decisions for you, you really have to take time to understand how the market works and what different investments might be best. I especially see this with women quite a bit. Generally, we've been told to leave our finances up to somebody else, a male figure like your dad or a boyfriend or a husband, figure out the finances, figure out the investments, and kind of blindly trust somebody. But in order to have your own financial independence and really be able to reach your own financial goals, you gotta know what's going on and you gotta take time to learn about it. You're more likely to get caught in a bad trade if you don't understand what's going on. And if you have goals that you really want to achieve, you need to understand for yourself how the market is working. Which leads me to my next mistake. I think it's really easy to, listen to the whispers of friends or colleagues about something that they're investing out. Maybe they're shouting, maybe it's not a whisper. Or even what we're told in the media, people on TV or YouTubers. You gotta do the research for yourself and figure out what is best for you rather than being influenced by others. Don't let the FOMO get to you. Think about like GameStop or Dogecoin when those blew up in the news and you couldn't look anywhere without reading about it. Something like that can feel easy to want to jump on the hot trendy bandwagon. But by the time it's the news, there's a high chance you might already be missing the crazy, investment returns that the people who got on really early were receiving. While investing money is exciting, it's not about getting rich quick. Ideally, you'll actually hold on to your investments as long as possible because that's how you can really maximize returns. Put your money in, forget about it, don't touch it. When I think about my finances, I try to kind of forget my investments. Obviously they're a big part of what I have saved up in my financial journey and wealth building journey. But when it comes to the money I have on hand, I only really think about what's in my bank account. I'm oh, that's money I have to be able to spend on whatever for the next 5 or 10 years. So everything that's invested right now, I'm I don't even look at it. I don't touch it. It's not for me to use. That's for future me down the road. This is really one of the most important elements in investing, is using the power of time. One of the biggest gifts of investing in your early 20s is that you're able to keep your money in the stock market and really grow those investments. It's really important to be honest with yourself. Do you have time and energy to spend researching individual stocks and companies? If not, I do not, nor do I really want to, but a more hands-off long-term approach might be better for you as well. So those are some of my top investing mistakes to avoid for beginners. I hope that was helpful to you guys. If you have any questions, feel free to leave them below. As usual, it helps me a lot if you leave a little like and subscribe to my channel. Stay tuned for more investing videos, finance videos down the road. As usual, thanks so much for watching. Bye-bye.